everyone, to the first Stallion Capital Management podcast. Wanted to give an overview about what's been going on in 2021 and then what we see happening in 2022. My esteemed colleagues are with me. My name is Vincent Beleja. I'm the founder and chief investment officer of Stallion Capital Management. With me are
Jeremy Youngbauer, the Director of Investor Relations.
And Justin Vollmer, Director of Fund Operations.
Brian Outlaw, Director of Business Development.
So today we're going to go over a few different categories for updates and then really kind of just discuss some relevant issues that we're facing as fund managers. And so today we're going to look at STREF, that is the Stallion Texas Real Estate Fund, the performance and how that year has been, new developments there. We're going to look at Stallion Capital Real Estate Fund 2, or STREF II is what we're referring to. So our second debt fund that was launched earlier this year, the performance of that for this year, what we see for next year, and then the new equity fund that we've launched, which is the Stallion Growth Fund. That's going to be really new. It's a completely different concept than what we've used before in our debt funds. Sorry, Jeremy.
Jeremy's excited.
Hope you're okay.
Just a little
Jeremy's excited about the growth fund.
Stays away from Christmas here.
It's the fund. The fund is going to be that exciting for us. It's going to be neat. So you're going to like that. Then we're going to talk about how this growth fund is going to work, why it's interesting right now at this time. And then we're going to be talking about some of the issues that we're facing right now in the economy, inflation, real estate values, what the Fed may or may not do, and what how we think that's going to affect the real estate market in general, but then specifically our different funds, including this new growth fund. So with that, gentlemen, I think that we can get started and move on to the STREF and talk about how it's done this year.
Yeah, I think that's a great idea. Let's just start with what we're seeing right now and kind of where we're ending the year. We are projecting right now to end the year with quarter four results at 1.7% return net to investors. So right now we're trending in the right direction. We're trending at about a 7% annualized return. This year we'll finish out a year to date at about a 6%, which is the right direction. That is fueled mostly by a very healthy portfolio. I think we were talking about this a lot with amongst ourselves and with some of the other investors that the properties that we're seeing that are coming in are very strong. And what I mean by that is we have not actually foreclosed on a property that we have underwritten since 2019. We did foreclose on one property that we originated in 2019, actually made a very healthy profit in that one. Before that, it was 2018. So we've got a really strong portfolio, fundamentally great income that's being generated. Obviously, and this isn't a surprise for a lot of folks, we've been selling through an REO portfolio. We've made great headway over the last year.
And Justin, maybe give a little insight on what's different. Why haven't we foreclosed on any properties in the last 2+ years?
You know, I think we put a large and very heavy emphasis on value, and it's becoming the forefront of. It's always been the forefront of underwriting criteria, but as we saw in 2020 and especially in 2021. With values were really, really inflated. And we were seeing appraisals come back on a lot of the properties that we were underwriting very high. And I think we were being extra careful. And in some cases, although borrowers don't like this, we would take haircuts on the actual value that we would assign a particular property because we felt that it was really unsustainable. And we're actually seeing that now. We're seeing the market kind of cooling off. And I think the conservative play that we took in 2020, especially through 2021, has really paid off for a strong portfolio.
Oh, it's good. And so, like you said, we have sold through a number of foreclosed properties this year. Still have a few on the books, but we think that by end of Q1 of 2022, the majority of those will be sold out. And all that really does is just increase the income of the fund. So. Right. Maybe to put a bow on the STREF I performance for this year, Justin, like you said, we'll be ending 2021 at maybe just slightly north of 6%. Mm-hmm. We're already running at a 7% net to the investor rate of return, and we expect 2022 It's hard to say that. I can't believe it's 2022.
Right.
It's going to be 7%, maybe just slightly north of that.
That's right.
And we'll have very little REO properties left at the end of the year. And right now, it's kind of business as usual. I do want to mention that on the origination side.
Yeah.
For the debt funds, new record this year as far as new originations that we put out. As we sit here on December 22nd, it's at about $90 million, and there's a few more that may be closing before the end of the year. So the demand side seems to be very strong. We have seen a decrease in interest rates.
Yeah.
Because there still is a lot of capital in the market, a lot of competition. But we still have very strong relationships with our borrowers, our repeat borrowers, and so those relationships have paid off. And we've seen a lot of our borrowers be very successful this year on the debt side. So that's good.
Yeah, the demand is up, and I think it's really interesting too because we go to several conferences across the country, and one of the things that we're hearing and we're seeing as a trend in the private lending space is the fact that private lending is becoming more mainstream than it was 5-7 years ago when it was really just solving a problem that banks couldn't fill. Now it's becoming more mainstream. We're seeing a lot of our borrowers that are quote unquote, what we call bankable, coming to us for the speed, the expertise, and everything that private lending offers that really just are obstacles in the eyes of our borrowers when they approach banks. So demand's been great this year and over 2020.
And what are some examples of the type of loans that we do?
Yeah, we're still gonna be looking at kind of our bread and butter, what we call urban infill, ground up development, residential, 1 to 2 units on the single family side. We're always approaching land very cautiously. Just the fact that no one kind of knows when things will start cooling down such that we'll see values maybe start, plateauing, maybe decreasing, and land is one of those first that would take a hit. So we're very cautious on our land, our LTVs on our land. We're also looking at small multifamily. These are just mostly townhome communities and some horizontal development as well for communities as well. So
that's right. So we'll move on to STREF II. So STREF II is a smaller of the two debt funds that was launched earlier this year, January of 2021. The assets under management is about $5 million.
that's right.
And so far, we're looking at closing the year out maybe just a little bit south of 7.5%.
Correct, yeah.
So not bad return at all for the first year in the fund. Everything has worked really well. We've had a lot of questions, though, about you have STREF I, and then you have STREF II.
Right.
Is STREF II replacing STREF I, or why do you have these two funds?
Right.
It'd probably be just a good time to get into the why behind it.
Yeah, that's great. I go for that one real quick, but there's several reasons really. STREF I, the original kind of signature flagship fund, was approaching $100 million. That was always kind of the goal, is where we would cap that fund, and we knew that day would come. So we approached that, and we were also simultaneously looking at an opportunity to incorporate what is known as a sub-REIT structure inside of our debt fund. And what that allows us to do is take advantage of a 2017 tax law, specifically Section 199A, that allows high income earners to qualify for the qualified business income deduction that most are able to do. So it's kind of a loophole in the tax law that if you have a sub-REIT in your fund, all of your investors, no matter what they earn annually from an AGI perspective, can participate in this deduction. Well, as we decided, we saw that there was going to be quite a considerable investment to install a sub-REIT in the original fund. So we actually saw that it would behoove us and be cost beneficial to actually create a new fund. And so we were able to do that. STREF II now incorporates a sub-REIT, and there's several tax advantages that come with that. So we're happy, to talk to more of you independently about what that looks like for your investment. But we saw that as a big benefit to our investors to go ahead and do that.
Let's talk about that just for a second. So, Jeremy, you did had an investor meeting the other day. You did a great job about maybe very practically who the sub-REIT is really for and kind of at what levels it starts to make sense, which kind of helps guide certain investors into maybe STREF II versus STREF I.
Yeah, absolutely. And so as we continue to see STREF I stabilize out, there's really going to be a lot of similarities between the strategies and the returns. And so it's going to boil down to, okay, which one? Like exactly what you're talking about. And with the income of high income earners, when you look at it from a tax perspective, it may make more sense for that individual investor to go into STREF II to take advantage of that qualified business income tax deduction. So that's one of the first hurdles that you would look at when you're comparing both funds. Okay, would I qualify for this, and does it make sense to?
And what's that number?
I believe it's a little over 300,000 or 315,000 earned income per year. So if you're making that or more than that, then STREF II generally would be the fund you would go into. And if you're below that or generally retired or have less earned income than that, then really either one would make sense. STREF I is still very attractive because the amount of assets under management plus the amount of loans that we have in there, it is the better fund as we continue to build out STREF II.
Right. Yeah. So just to summarize that, because that can be kind of confusing, is just that, okay, income earners that are making above $300,000 per year, wanting to come into a new fund, STREF II probably makes the most sense because of the sub-REIT, which allows the tax advantage. People that are below that $300,000 mark, really either fund will work, but STREF I is a larger portfolio. You're going to have a little more diversification there, and then the yields between the two funds are really pretty similar. Right between the two. So, but both funds they work very similar as far as the structure goes. I would say STREF II is kind of the more modernized fund, but STREF II continues to do well, and as we said, have had increasing yields. See similar yields in 2022, and as far as the loans that are going into either of these funds, they're very similar. So there's not a huge difference there.
Yeah.
Okay. So just to recap, STREF II for 2021, it's going to be a little bit below 7.5%. Seeing about that same rate of return in 2022, right?
Yeah.
Okay.
That's right.
Nothing really changed.
That's right.
Okay. So the big news, and one of the reasons why we wanted to put this information out, especially in this format, because I think it'll we're trying to make it as clear and understandable as possible. See if that actually happens. But is the new growth fund. So it's called the Stallion Growth Fund. We abbreviate it sometimes as SGF. It's an equity fund. So the big difference there is it's an equity fund versus STREF I and STREF II, which are debt funds. Debt funds are lending money to borrowers against property. And this new growth fund, the equity fund, that is actually purchasing properties directly and owning those properties. So pretty big difference. And I want to get into the story about it, but what's been some of the feedback that we've received so far from some of the investors that have come into or are coming into the growth fund about why they're interested in it?
Yeah, very exciting. There's a lot of interest in Texas as a whole. Everybody knows we have a very healthy economy, very healthy business market. All the headlines are talking about the companies that are relocating, the population influx that we're having. So I think people just inherently understand that real estate in Texas is a very good, very attractive market to be in right now. But people, that are interested in real estate maybe don't want to actively own it themselves. And they're really attracted and kind of like the strategy of us owning it in our fund, them getting to active or participate in real estate investment, but not having to actively manage it.
Yeah, well said.
So I'll talk a little bit about the differences, and I really want to harp on this one because I think it's important to understand at a high level the two different strategies. So the debt funds, STREF I and STREF II, they're a lower risk, lower return fund strategy. You're lending against properties in the first lien position. For years, we've been at about 70% loan to value or less, so there's equity. There should be equity in it in every loan that's going out there. But the growth fund, now we're buying the entire property, so there's no loan to values anymore. We're at 100% exposure, but we're looking at a target return of more of, say, 12 to 13% per year, instead of, say, a 7 to 7.5%. So significantly more return that we've targeted, but significantly more risk as well. Because Brian, I mean, you mentioned that we're lending in Texas, and it's a strong economy. We feel very good about those things. We've been in this market for over 15 years now, but your exposure is greater because you own all of that property, and so if you have market fluctuations in value, where you do have dropping values, then the value of that investment, the growth fund, can also decrease. So certainly any of our investments you can lose money in, but you're going to have a higher risk, a greater probability of losing money in this new one. But the other side of that is we feel like we can have good returns.
Right.
And I think that's understandable for a lot of investors to comprehend as a concept of, if we have a higher target rate of return that will be beneficial for them, that generally correlates to a little bit higher risk as part of the equation. But I think it's important for us to share as part of the story, and really the motivation for us to launch the fund is some of the experience that we've had in owning real estate and operating it through the involvement of the debt funds and some of the properties that we've had to take back and operate. So I think that could be an important aspect to share, and what part of our strategy is that we feel we're leveraging our experience in that to help manage some of the risk that's involved in us investing in these properties.
It's true.
Yeah, that's a good point. And really, kind of most recent example of that is earlier this year. Kind of hard to think about. It's really, I think it was January, February, right, when we took back this multifamily property in Dallas, and so we developed, the knowledge and know-how to get it finished out and ready to take to market. And so some of the people that bought some of the units ended up short-term renting out the property on Airbnb and VRBO, and so we got to talking with them, specifically Vincent and Justin, and seeing what they were doing and how it was working out. And they were very forthcoming and showing us their financials and everything, and that was very attractive. I believe 20% cash on cash return roughly is what they were getting, and then you factor in appreciation, which was I think roughly 10% for the year. So you're looking at an annualized rate of return of close to 30%.
Yeah.
Which is very, very attractive, right? And so that caught our eye firsthand.
It did, and what's so interesting about it is launching an equity fund has actually been on my mind for a few years. One of the difficult things to do, though, is to generate enough income to justify buying a property if it's going to be on a long-term hold.
Right.
Because a lot of times when you are buying a property and doing a long-term lease, you may be able to get 6 to 8% return in a given year. Of course, if you have rents increase, it might be a little bit higher. And then when you own a property, you get to participate in the upside if you have the increase in value. So that can be a good strategy. What we saw when we saw this short-term rental model was exactly what Jeremy was just saying, where you could maybe get to a 20%, maybe slightly higher, maybe slightly lower, but around a 20% cash-on-cash return. That's really good income. And then when you couple that, like you were saying, with an appreciating market, that translates pretty well into being able to generate sustained income and value growth over time. And I think that's really what our strategy is on this new growth fund is. It's not to get in and out of properties quickly. It's to build a portfolio. It's a long-term portfolio that's going to be building value. But what's really important there is having that income component. That's an important part for me. And not every property is going to have the income associated with it. But I want to build this foundation of income so that whether we have an appreciating market, a flat market, or even a falling market, we go back to that income. And if we can maintain around that 20% cash-on-cash return in a given property, that's going to set us up pretty well for the future because
Right.
a few things are happening, right? On one side, we're generating the income.
Mm-hmm.
On the other side, if we go and take debt out when we're buying this property, that's going to increase the return to the investors.
Right.
We're going to be paying down that debt.
Right.
And then over time, if we're selecting properties in strong markets, then you're going to have that appreciation. Now, we don't know that that's going to happen, but we really believe in the Texas story. And I feel like if you're selecting great properties in Dallas and Austin and San Antonio, and then maybe in parts of Houston, I think those are going to be really strong markets for the future. So I would expect to see a 3 to 4% annual increase in value.
Yeah.
And so you add all those things together, and it seems like now is a really good time to launch into this strategy. But again, this is a longer term strategy.
Sure.
Let's talk about maybe some of the differences. I know we started on it at first, but the debt funds, 18 months
Right.
on the commitment period.
Initial period of 18 months, right?
Yeah, and also keep in mind it's an important component to a lot of our existing investors is the actual quarterly dividends and the distributions that come with an income fund. When we're looking at the Stallion Growth Fund or a real estate private equity fund, in many cases, I'll talk specifically about the Stallion Growth Fund. It's a long-term capital growth strategy. So it's a 36-month commitment, 3-year commitment. The distributions may or may not happen. Likely, distributions will happen at least once a year to satisfy tax liabilities for our investors. That's something that's very important to us. But
Could be reinvested as well if you wanted to.
absolutely. There's a reinvestment option, just like the other funds. But there's not that quarterly distribution that a lot of our investors have become accustomed to or have sought out the debt funds for. So that is a really important distinction right out of the gate. But from a long-term growth perspective, capitalizing on what we believe will continue to be great growth and appreciation in the Texas real estate, there's great potential there for that long-term growth. And I like what you said about laying kind of the bed of income. I think it's important to note that this fund can pursue varying strategies for income and for growth. We're laying the bed down. One of the strategies is the short-term rental growth because we believe that is an exceptional way to kind of outpace income more so than a long-term rental. And I was thinking that as you were discussing, it's kind of this put and take that you've got when you're investing in single-family real estate. I'm sure a lot of our investors have rental homes and can attest to this, but it's really hard to cash flow a Class A $500,000 plus dollar home that was recently built. It's hard to cash flow that right now with a long-term rental. So we're seeing that short-term rentals is just a great opportunity to really exacerbate the income 4, 5, 6x times what you could get for long-term rental. And there's other benefits that come with short-term rental that I'm sure we'll discuss as well. But I like how you said that. We really want to lay the bed down, and it'll provide us opportunities in the future to pursue other areas to kind of capitalize and look for those higher income strategies.
Absolutely, and I think it's important to note the type of properties and the specific markets that we are looking at for short-term rentals. These are Class A properties, either newly constructed or just finished completion on construction, with really nice amenities in very nice parts of downtown areas or right on the fringe of downtown where it's walkable to restaurants, live music, just a very attractive scene. So not only is the property nice, but there's some definite draw and appeal to people who are looking for short-term rentals that are drawing them there. And really, we're seeing good success right out of the gate with the occupancy rates for our projections.
So let's talk about what we would call our buy box for this equity fund. Now, this is the buy box for the strategy that we have for 2022. It's not necessarily going to be 2023 or 2024, right? We're looking at building this portfolio for this year.
Setting the foundation.
The foundation. And the foundation is going to be, okay, first we're looking at returns, right? So you want to see this 20% cash on cash return. That's number one. Number two is we're looking at the range of, say, approximately $500,000 up to $800,000 for a unit. Now that is higher than you would typically look to go buy when you're trying to produce a rental income. But what we've seen is that in that range, you still have good return on the short-term rental income, and at that range, you can also pick up a decent amount of appreciation if you have that property increasing in value 3 to 4%. There's a big difference between, say, a 4% increase on a $200,000 property versus a $600,000 property, right? Which you've got 3x the real return there. Also, so metro areas right now. So things that aren't super seasonal, where we think we're going to have very strong occupancy. We want to see about 75 to 80% occupancy in these properties, and there's a number of ways for us to go and get that data for us to be able to make an educated decision. So if we see the return, if it's within that range, and if we believe that we're buying into a market that should appreciate, even if it doesn't appreciate next year or the year after, but has strong fundamentals. Because we have seen so much appreciation over the last 2 years, right? We could be entering into a little bit of a cooling off period.
Right.
But fundamentally, it's where people want to be. And then what Ryan mentioned, right? There's some type of amenity, there's some type of draw to that property, whether it's location, whether it's a lot of the properties we're looking at have rooftop decks right now, or they have some type of entertainment area, or they're really good for having maybe a larger party stay.
Right.
Right.
Really nice kitchens with great, countertop space where you can cook a big meal and, have a group of your friends or family together and have a feast or a celebration, or just really, settle into the property and make it an enjoyable experience.
Also, new properties. Mm-hmm. So everything that we have in the portfolio or that we have in the pipeline to purchase is new or was built in the last year, maybe 2 years or so.
Yeah, I mean that eliminates deferred maintenance. That eliminates, quite honestly, just the normal decay that you'd get with an depreciation of an older asset. A lot of times we're getting builder warranties as well, which is very helpful.
Decreases costs.
Yeah, it keeps the expense ratio down on the repairs and maintenance side for quite some time. So that's a good point.
So that right now that's a strategy. We're going to probably look at acquiring anywhere from 25 to 35 of these properties over the course of this next year. That may seem like a lot, but we've really laid the infrastructure to be able to manage those properties. Speaking of which, a lot of these, we get the question is who's managing them?
Right.
Well, we are, but we also have on-site managers that professionally manage short-term rentals in these geographic areas. Right. So we're really getting a lot of guidance, even on the buy side, right, for these properties, because we're getting a lot of real-time data so that our projections are accurate. Right. And what we found is that so far we're matching the pro formas that we're putting out, which is great to see, because it means we're actually achieving what we set out to, which is a big deal. It's great. So that's really good to see. Though there is probably a little bit. There's a little bit of growth, right? You buy a property, maybe have a lower rental rate until you build up reviews, build up reputation. You increase that. But what we've seen so far has been performance in line with expectations, which there's not much more that we can ask for on those properties.
Right, which is great to share with investors, current and new, but really for current investors, because a lot of the conversations that Brian and I are having is where they've seen this type of strategy before or had direct experience with a short-term rental strategy, and so they know it, they get it. It's fairly easy to understand if they've had the experience, or if they were wanting to look into it but didn't have, didn't want to go buy the property, like Brian was saying, this the active versus passive, right? And so that's where it is more attractive for us for the passive investment, as we do all the management and help prove up the strategy, which is obviously has been going well so far.
Yeah, we get that question a lot, like why wouldn't I go out and do this? And we always say, of course you can do this, and it's a good strategy. But I'll never forget, I ran into an investor one time that was really involved with short-term rentals, and I really asked the difference, what do you think the difference is between short-term and long-term rentals? And he said it like this. He said, long-term rentals is really an investment. It's a passive investment. We know mailbox money, right? We've heard that term. Short-term rentals, he said, is a business.
Mm-hmm.
And there's so many components, from bookings to monitoring the reviews, to reacting quickly to guest needs. Because again, this is nightly rentals. This isn't take a week to fix a toilet, right? They're paying top dollar. So there's all these needs that go into it. And I think we built just a great team, boots on the ground team that really helps us operate these things successfully, and will take us into the future. But business versus investment. It's a whole,
good.
yeah.
Mm-hmm.
I like that. So that's really the strategy over this next year, trying to raise about $16, maybe $18 million of new equity into the Stallion Growth Fund. New equity meaning investor capital. We'll be using a leverage model to where we're going and getting bank financing that'll go up to 75% or so of the purchase price of the property, and then taking that 25% of cash in the purchase from the investor capital that's contributed to the fund. For anyone that's new to Stallion, all of these funds are the Reg Ds. They are for accredited investors, and so if you're not an accredited investor, unfortunately, you can't participate. So just wanted to put that out there, just to be clear about that. $100,000 into any of the funds, but we also look at aggregate relationships with Stallion Capital Management. So if you have $100,000 or more in one fund, then you won't need to write another check for $100,000 into the growth fund. With that, I want to talk about some of the things that we see in the real estate markets right now, right? Because right now we're lending money on real estate, which has worked very well for a long time, should continue to put out some good returns. Now we're going and buying real estate, but things feel a little uncertain right now because you have a number of things going on in the market. You have inflation, which has really kind of reared its head for the first time in a long time. You have interest rates.
Yep.
Right, that Powell has come out and said that the Fed is going to be raising interest rates.
That's a whole other conversation for us. We can
Maybe
have
3 times.
Yeah.
Over the next year.
Supply chain issues.
Right.
That we're seeing. I don't know if you all have checked the news in the last couple of days, but lumber is back on its way up.
Yes.
Yeah.
We're seeing that again based
Material
on
cost.
supply
Yeah,
chain.
no, a lot of factors, but I think maybe we take them, one at a time and maybe focus on the inflationary aspect of it, where, the Fed has commented that inflation is not being seen as transitory by them. It is something that we feel we realistically are dealing with. Maybe talk a little bit about why we feel that real estate is a great place for investment during an inflationary environment.
Well, I think we will. But Brian, I think the first place I want to go with it is what are we facing right now, right? So the CPI is at about 6.2 or 6.3%.
Yeah.
So 6%. So consumer, the PPI, which is the producer side, is up around 9.5. And so if you ask the question, do I think that inflation is going to continue throughout 2022? I would say yes, right? And we'll talk about how it hits the real estate market. But I think if we're going to come down on a side, it's going to be that we're probably looking at 6 to 8% inflation over this next year. Could be wrong on that, but there's a few things going on that would make me think that. I just kind of want to get these things out there.
No, I think it's good to provide context for it for sure.
So one is we already have it. And there's an expectation, I think, of more inflation now. I think if you look at a lot of the articles that are out there, there was a lot said about the transitory comments. Now it's not transitory, or at least that's what the Fed's saying, right? The Fed's is taking action, but some would say not the strongest action against a 6 or 7% inflation rate, right? They say they're going to raise the interest rate by maybe 0.75 of a point, maybe 1% over this next year.
Yeah, which many could argue that should have happened a long time ago, right? So
right.
That's the crux there, yeah.
So that may work, it may not.
Right.
And then you have the Build Back Better.
Sure.
Which right now looks like it may not pass, but it could pass.
Sure.
And whatever you think about the legislation, I think Build Back Better is what, $1.5 trillion?
Two.
Two
Right at two,
right?
yeah.
So that's $2 trillion that would be coming into an inflationary environment already.
Right.
So if that passes, that just, for me, that makes me really think that, okay, for this next year, we're probably going to have that baked in.
Right.
And if we do have it baked in, then what is that going to do to the real estate market?
Right.
Right? So, yeah, what are the thoughts?
Well, obviously, with interest rate hikes, we will probably see a slowdown in the purchasing trajectory of new homes. Still have a supply issue, so that'll be interesting to see how that weights out, and kind of which one wins on the balancing scale there. But inevitably, I think we'll definitely see a slowdown there. I think we will see an increase in rental rates as well. I think as it becomes increasingly harder to purchase homes with the rising interest rates, and quite honestly, just outpriced homes right now. Affordable housing is a whole other subject, but I think we're going to be able to see more people moving over to the rental market, justifying rental landlords and owners the ability to increase rates. We've already seen it. I think anecdotally, even around this table and around the office, for people that rent, we're seeing $300-400 rent increases already for renewals. So I think that's one aspect and one component that we're going to see from interest rates that are rising.
Yeah, that's a good point. And also with that, we've had historically low interest rates for a long time. Kind of back to your point, probably should have, looked to increase rates earlier, but we're not part of the Fed, and so with that, yes, interest rates will rise, maybe a quarter of a point per time they do it. So it's going to be incremental over time, and so with that, rates will still be very low. And so one of the things that contributed to the market that we've seen over this past year, kind of the buying frenzy, is where buyers were able to buy more of a home because of rates are really at their all-time lows.
Right.
And so anywhere from 2.5% to 3.5% over the course of the year is what we saw. So rates are still going to be low as we get into next year. So part of that, yes, I think it's going to decrease the home purchasing a bit. But I think it's also going to kind of maybe have it come down to where people aren't buying more of a home than what they've been doing over the past year and a half, 2 years. Does that make sense? And so just because rates will be increasing, that'll increase the mortgage payment, maybe come back down to a house that they maybe should be buying in the first place, depending on their current situation, and kind of go from there. That's just a thought that I have.
Sure.
But it just still makes sense.
But I think all of those factors contribute to say that we foresee the rental market continuing to be strong, not only for demand standpoint, but also the ability to increase the price of rents to be in line with inflation. So
yeah, there's a lot of reasons why real estate. I mean, we can talk about specifically why real estate would be a good hedge against inflation. I think the number one, and you were kind of alluding to this, but really on the buyer side, but for those that already own real estate, you're in a really good position in a high inflation environment because your debt that you've got against the property is fixed for the most part, yet your value continues to escalate. So for the most part, people that are in real estate right now will make out pretty good. For the buying side, it's tough. The other thing that's great from owning real estate, and specifically in an investment strategy, if you're able to position that real estate as an income-producing property, in this case short or long-term rentals, you're able to reset the rates such that you can actually keep up with inflation. So in a long-term rental, you're usually signing 12, 18, maybe 24-month loans, leases. And you're able to reset that with the market conditions. Short-term rental, I even like even more because that is really nimble, and we do what's called yield management, and we're able to increase and decrease on a nightly basis. We're actually able to be that nimble with it, and I think that's why I'm really excited about this strategy is just because on the micro level, the adjustments we can make.
The ability to have your thumb on the pulse of the market and
Right.
adjust what that rate, which ultimately generates the yield, is going to be on a much quicker real-time basis.
Exactly.
I think it's a great point.
Yeah, in an overall inflationary market, real estate appreciates, rents increase for the most part, and
Right.
from what we've seen in past. Of course, past performance doesn't dictate future performance as well. But all of those are positives for real estate
Right.
and owning real estate.
So let's break that down. So on the positive value side, we have inflation, which should push real estate prices,
Right.
and inflation should be, and real estate should be a good hedge against inflation. We also have supply chain issues, which is continuing to keep the cost of new housing
Right.
high.
Right.
We have low supply, at least in the markets where we operate, so there's scarcity. There continues to be high demand for those because people continue to move to Texas. If you look at the statistics for 2021, I think Texas was net 1.3%
Yeah.
in population.
Right.
So I think maybe that might be the highest percentage population increase in the states. If it's not the highest, it was in
close.
the top 5.
Yeah.
So that demand is still there.
Right.
On the downside, you have possible increase in interest rates, right?
Right.
Which means people can't buy as much house as they could before.
Right.
So put downward pressure on values. But what's interesting, right, was what was brought up is those higher interest rates might actually push rental rates a little bit. Maybe the jury's out on that one a little bit, but
Yeah.
that could be the
I
case.
believe so.
Yeah.
That's where I stand.
And right, it's good.
Yeah.
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 And so, what will next year look like? Ultimately, we don't exactly know.
Right.
But that's why I think for the growth fund, having that foundation of income is going to help to be kind of a shock absorber if we do have a decrease in values. And then on the debt funds, right? That's why we have that 70% loan to value ratio, is to have that 30% equity to be able to absorb the shocks there. And I don't think that we're looking at if we do have a decrease in real estate values, a 30% decrease. I think
Right.
it could be.
I think that's important to note, and I think it's also important to share the strategy that we've implemented within STREF II and the loans going forward, being on a floating rate basis, to
That's
where
right.
if interest rates do increase, we're able to continue to keep up with that and adjust the interest on the loans that we've made to help keep that yield steady.
That's right. Yeah. And so I just want to just flesh that out a little bit more, Brian. But great point. Earlier this year, when we started seeing inflation start to creep, we thought, okay, the Fed might address this with interest rate hikes.
Yeah.
If we do that, we want to be able to really benefit from those interest rate hikes. So we went to a floating rate, Wall Street Journal, plus a margin, to where if we do have the Fed make those increases over this next year, that we'll be increasing our rates as well with our borrowers, so we can maintain the yield that we have. So thanks for bringing that up. I think that was a thing that I think is very important, and we're doing that with every loan now, and we'll continue to do so, because it is hard to predict exactly what the Fed's going to do, and we don't want to see our margins shrink if the Fed does increase those rates on the debt funds.
Yeah, and I think I just want to talk about kind of the elephant in the room of when we made that switch. The concern was what would it look like from a borrower's perspective. But the reality is anything that is not a traditional, maybe Fannie Freddie type of loan is going to have a floating rate to begin with. So our borrowers were already seeing this. So I got a lot of questions from our existing investors say, how was this received from our borrowers? And to be quite honest with you, it was well received. Maybe that's the wrong way to describe it. Maybe not well received, but
They felt like it was fair.
Yeah.
It didn't come across as something that was
been normalized.
unfavorable to
Right.
them. It's a common practice in the marketplace, and
Right.
they understand it. And again, I think our first class service, the relationships that we have with the borrowers, the speed that we execute, truly being their strategic partner to execute their projects. All in all, they still feel like we're a great partner to do business with.
yeah, no, for sure.
And the other side of that is that the loans that we're doing in the debt funds are short-term loans. They're 12 to 18 months. Having a 0.25% increase in those rates over 12 months or so isn't going to be a huge financial burden for our borrowers there.
So Vincent, as we wrap this up, I'm going to put you on the spot. And I really want to ask you a specific question regarding the vision of Stallion Capital Management for the future. And I say that because as I look back, even before I wasn't here, I know kind of the origins of kind of the one loan and one investor, and how you've grown that to a fund, to several funds now. And what's really the goal for the investor? What's the long-term vision, if you can, in just a couple minutes, to let us know what this growth looks like for Stallion Capital?
Well, so first thing is this: it's really so we've grown this, right? So it's not me.
Thanks, Vincent. Yeah.
We
He's
have.
talking to me.
Yeah.
Jeremy and Vincent.
That's right. Yeah, we have. Yeah. We've grown it, but we've grown it with our investors as well.
Sure.
And so it just wouldn't be giving people the credit that they're due without looking back to our investors and then putting trust with us, with their capital, which is such an important relationship and such a huge deal. The vision that I really see for Stallion Capital Management is that we are a place where an investor can come in and gain exposure to real estate in their risk category, right? So they can come in and they can say, okay, income is important to us, and stability is important to us, and capital preservation is very important to us. So the debt funds are a great place for that, because we're doing our very best to preserve capital, still have an attractive rate of return, and provide income for those that need it on a quarterly basis. And we're diversifying away from the market, and we are exposing to real estate. So there's certainly the risk that comes from that market.
Sure.
But it's a place where if someone says, I love tangible investments with these type of attributes, and not only that, I'd like to be in the markets that I know. I think it's pretty neat I'm from Austin, right? But it's neat for me to even see our own signs around town, and I get so many comments from people that say, oh, we saw your sign downtown, or saw your sign on 1431, or we drove by your sign. Being able to actually be next to the investments that you have, I think is pretty neat, right? You just feel a connection to it as an investor. So having the debt side, but then for our other investors that say, the income isn't as important to us, and we're really wanting to build for the long term. Now having that side, that's also in real estate, right? Where we're building a portfolio that is going to have higher returns, and income isn't an issue because we have enough of that right now. So we're really looking to build wealth in a way that's very tangible, that's very understandable, that is directly related to a market that they can see. I think that's important for a lot of them. And then even looking down the line, I'd really want Stallion Capital to be known as a place where we can find the right real estate investments to diversify us away from traditional investments that are out there, but also really provide great returns, whether it's on the debt side and the income, whether it's on the equity side. And so we can really just be a trusted partner that someone can come in, they can look to see exactly what's in the portfolio. They know exactly what's going on, and they can go and visit the properties if they so choose. So it's just a different feel. And then the other side of that is that relationship has always been our number one core value.
Right.
And we want to be a place where someone can come in and have a conversation with us, sit down, grab some coffee, and really talk about exactly what's going on and what's important to them and how can we really serve them. So that's a little bit of a rambling vision.
No, that's good, and I'm really glad that you touched on the relationship, because I know that is important. This business would look completely different and have grown in a different trajectory if you would have put your attention on attracting institutional monies. And I think you made that decision a long time ago, very strategically, that it was more about the one-to-one relationships. Because an institutional pension fund insurance, there's no relationship there. It's just about the numbers. And I think relationship to all of us is just so important. So I appreciate you casting that vision for us of the future. And as Stallion Capital continues to grow with the new funds and new opportunities, I think that's important to convey to our investors and potential investors. So does anyone else have any parting thoughts of wisdom here before we wrap up? I just love this opportunity to be able to discuss this stuff with our investors and our potential investors.
No, it's great. Continue the conversation. Love the Stallion Stable Podcast. We'll see. Jury's still out on the
Jury's
exact
still
name.
out on the name of the podcast.
No, I think I just speak for everybody when I say we're truly fortunate and excited about being able to do business in this market in Texas, and real estate be the underlying theme for what we do. So just invite everybody, current investors, prospective investors, to reach out to us. And we'd love to have a conversation with you and love to answer your questions in more detail and just explore ways that what we do can be a good fit for you. So thank you for the time, and just invite you to reach out and talk to us.
And also just want to say we wish you a very Merry Christmas. We have Christmas in a few days here. And we hope that you have a wonderful new year. We hope that we can deepen our relationship with you over 2022. We're really excited about what's going on here, but we really want to hear from you and see how we can best serve you. So God bless you. We want to sit down with you whenever the time is right. And if we can do anything for you, please reach out to us. Let us know how we can better serve you. We wish you the very best for 2022. Take care.
Merry Christmas.
Bye.